following is a video training module on business valuation by businesstraining.com. Business valuation is one of the most important areas of knowledge for the business broker to have. In this video, we will discuss the purpose of a valuation and go through the steps needed to do one. What is the purpose of any valuation? It is to determine what something is worth. In our conversation, a valuation is done to determine what a fair price is for a small business at a particular point in time. Keep in mind that all valuations are done as if the business is being sold. Business brokers do valuations primarily to determine an appropriate asking price for a business they are going to list and try to sell. These valuations are not as extensive as ones done by a valuation company. Keep in mind that even if you have the certifications to do a valuation for a fee, there is potential liabilities and conflict of interest if you are trying to sell a business. The normal broker valuation is similar to a BPO, or broker price opinion, in commercial real estate. Valuation firms do valuations for a variety of reasons. They are independent, certified, third-party valuations. Such valuations are expensive, especially if used to legally defend a value in court or to the IRS. These valuations are also used by the SBA to support small business loans. They are similar to an AIA, commercial appraisal in real estate. The first thing we will look at is the balance sheet. The balance sheet is simply the accounting statement prepared to show the assets and liabilities of the business at a given point in time. In looking at the figures you have, hopefully the last 3 years, you want to be aware of large fluctuations in value. In most cases, you compare balance sheet items for year to year by calculating them as a percentage of total assets. However, if the item is listed on the liabilities or owner's equity side of the balance sheet, then compare it to other years as a percentage of the total liabilities plus total owner's equity. Understanding the fluctuations you will find will tell you a lot about the relative health of the business. You should study inventory levels and see which method of value is used. Last in, first out, and first in, first out may require adjustment to compare the levels to others in the industry. In reality, most times you can simply adjust all usable inventory to replacement costs. This is often a large part of the assets being sold, and it must be usable and valued at cost, not retail. Another aspect you must be aware of is the relationship of the inventory level to the cost of goods and thus net income. If a small business always shows the same amount of inventory at year end, the owner assures you the actual amount is more, and this is not a good thing. It means that the net profit of financials that you see is stated higher than actual because the cost of goods was actually higher. It is not our intention to cover this in detail right now. Simply be aware that this type of problem may exist. The other thing you should study about inventory is what is its relationship to gross sales. If annual sales are $1 million and the inventory value is also, the inventory is only turning one time a year. This also is not a good thing. You would like to see inventory value of 1/12 of annual sales to have 12 times a year or once a month. Other assets in the business should be also valued at replacement cost. Because the inventory and other assets will comprise a hard asset value of what is being sold, the number needs to be as accurate as possible. Most small businesses are being valued and sold as an asset sale. This means that the seller will keep the cash in the business, pay the payables, and keep the receivables through the date of the sale. Thus, you can zero out these items on a balance sheet. This gets us into liabilities on the balance sheet. Loans to owners or shareholders are generally removed, as are other liabilities of the business. You should still examine these to see if, for example, the company is slow or otherwise having problems paying its bills. Let's look at a simplified example of these adjustments for our company, Any Company LLC. The balance sheet you have from the seller is on the left. I have condensed the current and long-term accounts to simplify things. In an asset sale, we are trying to get to the assets that will transfer during the sale. The value of the hard assets on the adjusted balance sheet plus the intangible assets will be equal to the selling price. Looking at the right side, we have the following adjustments. First, reduce the inventory value at cost by $30,000 for obsolete inventory. Then, zero out the accounts receivable as the seller will retain these. Zero out the cash and cash equivalents as they will also stay with the seller. Reduce the furniture, fixtures, and equipment to actual value. Zero out the accounts payable as the seller will pay these. Zero out the bank loan as the seller will satisfy it at or before closing. I have never seen a business where bank financing is assumable in an asset sale. Zero out the loan from members. Zero out the members' equity. We are left with a hard asset value of $675,000 that will transfer to the buyer. Our next and most important step is to adjust the income statement. This is also called the profit and loss statement, or P&L. It shows the income and expenses of the business for a period of time. Two types of adjustments are commonly done: normal and discretionary. Normal adjustments are used to get what accountants call EBITDA. This is earnings before interest, taxes, depreciation, and amortization. You take net income and add to it the depreciation, amortization, and interest expense to get the EBITDA. Keep in mind that the entire amount may not be an appropriate adjustment. For example, interest expense in an auto dealership for a floor plan, non-owned inventory may be a cost of doing business. The SBA also adds back one owner's salary to get to SBA adjusted cash flow. Discretionary adjustments are made to identify and add the items that are to the benefit of the owner or owners, even though they show up in the financials as an expense. These include auto insurance and maintenance of the owner's vehicle, contribution to the owner's favorite charity, life and health insurance premiums on the owners. Also, we add back unusual one-time expenses, for example, a new machine expense in the year, not depreciated. That may last several years without needing replacement again. Something like a settlement of a lawsuit would also be shown as a one-time expense. The total of these adjustments are added to the SBA cash flow to arrive at the seller's discretionary cash flow. Let's look at an example of this. Here we have the income statement of Any Company LLC for the last 3 years. It has been put in this format, so you can easily see what adjustments we are making. You already know that sales minus the cost of sales minus the operating expenses will leave us with net taxable income. Note that sales are off in 2009. Also, net taxable income has ranged from $148 in 2007 to $25,000 in 2008 to $100,000 in 2009. If we use these numbers from the tax returns without adjustments, we would be making a huge mistake in valuation. For each year, we add the depreciation, amortization, and interest to get the EBITDA. These are the numbers that accountants look at. Adding the owner's salary gives us the numbers used by the SBA for loan purposes. Spend some time studying this slide to see how the numbers work. Now let's look at the discretionary items. Note that the things we are doing in this example involve adding to the cash flow of the business. There could be items that would deduct from it. For example, other non-operating income that doesn't affect the business should be deducted. Items that are commonly added back are 1. The payroll taxes on the owner's salary. automotive expenses related to the owner's vehicle, contributions and donations for favorite causes. These may be to a church or school, for example. Fair market rent adjustment, plus or minus if the rent paid is high or low for some reason. This is common where the owner owns the real estate and leases it back to the company. Insurance premiums paid for the owner by the business. Professional services that are non-business. Retirement plan contributions benefiting the owner. Travel, meals, and entertainment that may be non-business. For example, the owner may travel to Orlando for a convention that is related to the business. His wife and kids may go along for a vacation that isn't. These expenses are common. Remember that just a portion of these costs should be added back, those that are non-business. Telephone, cell phone, data, etc. may be partially non-business. Other discretionary expenses. One-time expenses, as we discussed before. After studying this chart for a while, you can see how this recast changes the perception of the business and as it relates to cash flow. Now we have a business that is cash flowing from $282,802 to $412,578 a year over the last 3 years. How do we value it? To get to the value of any company, we have to determine what multiple to apply and how. The first thing to do is consider risk. There are many kinds of risk involved, and they must be evaluated based on things that don't necessarily show up in the financials. Some are: what is the risk of the product being obsolete? Are most of the sales to one or two big customers? How hard is it for someone to enter the business? Is the company relying on one or two suppliers to keep the cost of goods low? You get the idea. These answers will come from your research of the industry and asking questions of the owner. Most small businesses have historically sold for between 2 to 3 times SDCF. Larger businesses, based on a multiple of EBITDA, may go up to 4 to 6 times. Let's use 2.5 times seller's discretionary cash flow in our example. Notice in our example that any company has had a decline in sales in SDCF. I would weight the cash flow as follows: 60% to the most recent year, 30% to the next year, and 10% to the third year. The most recent history is always the most valuable, although you can vary the weightings. Looking at the value with an average of the 3 years shows the effect of not waiting. At this point, we are pretty confident, based on the risk and multiple applied, that any co is worth between $750,000 and $850,000. Why the extreme rounding? Remember, the number you come up with will not be exact, and will largely depend on what a particular buyer is willing to pay. We have a good range to market the business. One last point: if we use $800,000 as our asking price, $125,000 would be the amount of the good will involved. This is the amount by which the price exceeds the hard asset value of the business. Well, now you know how it is done and why it is not an exact number. Good luck.